Welcome to the Deep Dive. Today we're slicing through AGNC Investment Corp's second quarter 2025 earnings call to grab the essential insights, basically getting you up to speed fast. Right, so first off the snapshot, AGNC reported a negative 1% economic return for the quarter.
Yeah, and that translated into a comprehensive loss of 13 cents per common share. Tangible net book value also took a hit, down 44 cents per share.
Okay, but before anyone panics at those numbers, context is key, right? This quarter was, well, wild for investors, especially leveraged ones in agency mortgage-backed securities.
Absolutely. Those figures really tell the story of the market dynamics. I mean, for someone like AGNC leveraged in agency MBS, those government-backed mortgages seeing spreads widen moderately, that's a direct hit.
What does wider spreads mean in simple terms?
It just means the gap between what investors earn on those mortgages versus safer stuff like treasuries got bigger. Makes the mortgages look a bit less attractive, relatively speaking. Puts pressure on returns.
And that wider spread happened against a backdrop of, well, serious market stress, particularly back in April.
Oh, yeah. You had the 10-year Treasury yield jumping around by over 100 basis points. The S&P 500 dropped, 12% at one point?
Yeah, serious volatility, lots of governmental policy risk, tariff talk. It sounds like a real gut check moment for the market.
It definitely was. But here's the interesting thing about AGNC. They navigated all that turbulence without any major issues.
And crucially, without selling assets under pressure, right?
Exactly. That's the key point. It signals they came into the quarter with a really strong liquidity position. They mentioned $6.4 billion in unencumbered cash and agency MBS.
Which was, 65% of their tangible equity?
Right. Actually up from Q1. So they had the cushion to ride out the storm instead of being forced sellers.
And more than just riding it out, they were opportunistic. I saw they raised capital.
They did. Nearly $800 million in common equity through their ATM program. That's the at-the-market offering.
And at a premium to book value, too.
Yeah, a significant premium. But here's a really interesting bit. They only deployed less than half of that cash by the end of the quarter.
So holding back, what does that tell us about their thinking?
It says they're patient, disciplined. They weren't just going to throw money at the market because they raised it. They're waiting for what they see as the optimal entry points, the best risk reward.
Makes sense. Now, we saw other markets bounce back hard after April. The S&P rallied, 25% from its lows. Corporate debt did okay, too.
Right, a big recovery in many areas.
Agency MBS didn't quite follow suit. They seemed weaker. Why was that?
Yeah, they definitely underperformed, relatively speaking. The current coupon spread, compared to treasuries and swaps, ended the quarter wider, 7 and 14 basis points wider, respectively.
And management had reasons for that lag.
They pointed to a couple of things. First, bank demand for MBS still seems, constrained. Even though people expect regulatory changes, that might help.
Okay, constrained bank demand.
Yeah.
What else?
And second, foreign investor demand might have been held back a bit.
Yeah.
Maybe concerns about the U.S. dollar weakness or just general geopolitical risk making them cautious. So specific headwinds for MBS.
So given those headwinds and that underperformance, what's the outlook now? Are they feeling pessimistic about agency MBS?
Actually, no. Surprisingly positive, I'd say. They expect demand to pick up from both banks and foreign investors as those regulatory reforms hopefully come through.
And supply, is that a worry?
They don't seem too worried. Seasonal patterns should improve in Q3, and they think net supply for the whole year will be around $200 billion, which is actually at the low end of forecasts. Plus, crucially, they noted spreads have started to stabilize since the quarter ended, still at historically cheap levels.
Okay, let's shift gears because there was a huge development this quarter, wasn't there? The clarity around the GSEs, Fannie Mae and Freddie Mac. That's been a cloud hanging over the market for ages.
Oh, absolutely. This was massive. Management flagged it as a real positive.
Yeah.
You had the White House, Treasury, FHFA, all basically coming out and reaffirming the government's commitment. The implicit guarantee behind agency MBS.
The implicit guarantee, meaning the government stands behind them, even if it's not explicitly written down everywhere.
Exactly. And President Trump's statement was pretty direct. He said, our great mortgage agencies, I am working on taking these amazing companies public, but I want to be clear, the U.S. government will keep its implicit guarantees. That's powerful stuff.
Wow. And Treasury Secretary Bessett added something too.
Yeah, Bessett basically said any privatization plan shouldn't widen mortgage spreads and ideally should tighten them. Plus, the FHFA Director P.Y. was clear about avoiding disruption or pushing mortgage rates up. It's a remarkably unified message.
So what's the takeaway for investors holding these agency MBS?
It means much greater confidence. The worry that the credit quality of these, $8 trillion worth of securities might be weakened during reform. Yeah, that seems off the table now. If anything, the backing looks stronger than ever.
And the practical effect should be tighter spreads over time.
That's the expectation. Less perceived risk should mean investors demand less of a premium, so spreads tighten, makes the assets potentially more valuable.
Okay, that's the big picture. Let's zoom back in on AGNC specifics. How did their portfolio and operations look this quarter? Leverage, for instance.
Leverage ticked up just a tiny bit, ended the quarter at 7.6 times tangible equity. The average for the quarter was 7.5 times. Management seemed fine with that, again pointing to their strong liquidity.
And income. Net spread and dollar income dipped slightly.
Yeah, down to 38 cents per common share. They said it was mainly about the timing of deploying that capital they raised, plus slightly higher costs for their swap hedges.
But they still feel good about the underlying economics.
Absolutely. They emphasize the underlying returns on new investments are still really strong, translating to something like an 18 to 19.5% return on equity at the margin.
So they expect income to stay in a decent range going forward.
Yeah, they guided towards generally staying in the high mid-30s to low mid-40 cents range. It'll depend on how their hedges roll off and, what the Fed does with rates, which impacts their repo borrowing costs.
And the assets they hold, any shifts there?
Yeah, the portfolio grew to $82 billion. And strategically, they shifted more into higher coupon specified pools.
Specified pools, meaning they're picking specific groups of mortgages rather than just generic ones.
Exactly. They're selecting pools with better prepayment characteristics, trying to avoid mortgages that might get paid off early if rates fall. Their average coupon went up to 5.13%, and they said 81% of their assets now have some kind of positive prepayment feature. That's a clear move away from just holding generic TBA positions.
Makes sense. What about the other side, the hedges against interest rate risk?
The hedge portfolio grew, too, to a notional balance of $65.5 billion.
Yeah.
If you look at it in duration dollar terms, its interest rate sensitivity was about 46% Treasury-based and 54% swap-based.
This mix significant?
Well, their long-term target is closer to 50-50. Yeah. They're slightly overweight swaps right now, and they mentioned that's partly because they expect to benefit from potential SLR reform. That's the supplemental leverage ratio, which could make swaps more advantageous.
Okay. And there was a change in their projected life CPR. Remind us what CPR is.
All right, CPR is the conditional prepayment rate. It's their estimate of how quickly mortgages will get paid off early.
And that went down?
Yeah, it declined to 7.8% from 8.3% last quarter. So they're expecting slower prepayments. That makes sense with mortgage rates being higher overall. And they specifically mentioned the yield curve steepening at the long end, which pushed future mortgage rates up and made refinancing less attractive for homeowners. Good for AGNC's returns.
Got it. Now, the Q&A with analysts always revealing, what key themes came up there?
Well, one was definitely that patient capital deployment. They kept getting asked about the cash they raised, but haven't fully invested yet.
And their response?
They basically doubled down on patience. They stressed they have the capacity to put that money to work at really attractive levels now. They mentioned current coupon spreads and swaps are around 200 basis points, the high end of the recent range. So they see great opportunities, but want to time it right.
Did the question of optimal company size come up? Can they get too big?
It did. Management was clear. Growth isn't the goal in itself. It's about finding accretive investments, ones that boost earnings per share, and supporting the dividend. They highlighted the benefits of scale, like their super low operating costs, and the stock's liquidity, which helps with getting into indexes.
But they acknowledge limits.
Yes, they definitely acknowledge that there are market capacity constraints. You can only get so big in fixed income before it becomes harder to trade efficiently. They're aware of that.
And the big question, long-term outlook for MBS spreads. Where do they see things settling?
They think a new, wider range has been set maybe 160 to 200 basis points over swaps. And crucially, they expect spreads to stay in the upper half of that range, or potentially even tighten from here.
And the main reason for that optimism is the GSE clarity.
Exactly. They see that as removing a major source of upward pressure on spreads. It fundamentally changes the risk perception in their view.
What about funding? Any worries about the repo market given all the Treasury issuance?
They seem very comfortable. They said they see no material impact from Treasury supply, pointing to plenty of market liquidity like trillions in money market funds.
Yeah.
Plus, they like recent Fed actions related to the repo market, like potentially broader access to the standing repo facility and the end of quantitative tightening. All that supports their current leverage.
Okay, a couple of quick ones. Any update on book value since quarter end and that new GSE credit score thing?
Yeah, quick update on tangible net book value. They estimated it was up about 1% months to date in July after accounting for the dividend. And the new credit score, Vantage score, they basically said it's not a big deal for investors right now. Need more data, more time for implementation.
And finally, prepayment risk. Did they reevaluate that? How protected are they really if rates were to suddenly plunge?
They talked about it. They know the market's efficient. Refinancing happens. But they argued you'd need a really dramatic drop in rates, like from current levels around 6.75% down towards 5% to trigger a massive wave.
And even then?
Even then, they estimated only about 27% of the whole mortgage universe would be in the money to refi at 5%. And AGNC's portfolio, with that higher average coupon of 5.13%, has significant protection. Many of their loans are still out of the money for refinancing. So yes, risk exists, but they think it needs a substantial rate drop to really bite hard across their specific holdings.
Okay, that covers the core of the call. Before we wrap, it's time for our thought experiment segment. This is not financial advice. An outrageous but maybe plausible trade idea sparked by today's deep dive.
All right, here's one to chew on. Again, purely intellectual curiosity here. How about this? A leveraged long position in AGNC common stock itself, but paired with a simultaneous short position in a broad market mortgage REIT ETFs, one that holds a more, let's say, generic or maybe even non-agency MBS portfolio.
Okay, long AGNC, short a general MREIT ETF. What's the thinking behind that pairing?
Well, it leverages several things we just discussed. First, AGNC's specific strategy focusing on those higher coupon specified pools, trying to generate alpha beyond just owning generic MBS. That differentiates them.
Right, the active selection versus a passive basket.
Exactly. Second, their hedging seems positioned for a steeper yield curve. Third, and this is huge, that reaffirmed government guarantee on agency MBS provides a unique safety net for AGNC's core assets that a more diversified or non-agency focused ETF wouldn't have to the same degree.
So you're isolating AGNC's perceived advantages.
Sort of. And finally, AGNC sounds confident about their funding and leverage, maybe more so than some peers, potentially allowing them to capitalize better on current spread opportunities. So the trade tries to capture AGNC's specific strengths and the potential tightening in agency spreads, while hedging out some of the broader sector risk or general interest rate moves through the short ETF position. It's aggressive, yes, but it isolates the themes from the call.
Interesting. Definitely food for thought. So let's bring it all together then. AGNC faced a really volatile Q2, showed resilience with strong liquidity, managed capital smartly.
Yeah, and came out with a surprisingly positive view on the agency MBS market going forward. They see manageable supply, growing demand eventually, stabilizing spreads.
And critically, that game-changing clarity on government support for the GSEs underpinning it all.
Absolutely. And maybe the final thought for you, the listener, is this. How might that very explicit top-level reaffirmation of government backing for agency MBS, especially with spreads still historically wide, how might that fundamentally change how people invest in this space long-term? How will strategies adapt now that a huge piece of uncertainty seems to be resolved?
That is definitely the key question to ponder. Thanks for joining us on this deep dive. Stay curious, and we'll catch you on the next one.